Time and time again, we hear from doctors about how they can make up for years spent in medical or dental school, residency, and fellowship from a financial perspective. And while speed is certainly part of the discussion, we found that structure matters much more. One of the unique things about your transition year is that it may create planning opportunities that simply don't exist again once your income fully stabilizes and increases, perhaps not even until retirement. I'm Josh Friedlander, Managing Partner of ArisGarde. Today, I'd like to walk through 6 tax planning opportunities that often become relevant during this transition. Before we jump into them, it's helpful to understand why this year is different. During training, your life has been organized around an academic calendar. Residency begins in July, fellowship ends in June. That's the rhythm you've lived for years. But the IRS doesn't recognize academic years, it recognizes calendar years. That means your transition year often consists of several months on a resident or fellowship income, possibly a short period between positions where you're not earning any income at all, followed by attending level income, all within the same tax year. That temporary difference in taxable income can create planning opportunities that may not present themselves ever again. So let's walk through the 6 of the most common ones. Number 1, Roth IRA contributions. This is one of the more familiar tax opportunities. A Roth IRA allows money to grow tax deferred, and qualified withdrawals in retirement are generally tax-free as well. The challenge for many doctors is that direct Roth contributions, Roth IRA contributions, are subject to income limits. Once you're earning attending level income for a full year, you may no longer qualify to contribute directly. Your transition year then may be one of the last opportunities to make direct Roth contributions before those limits become an issue. Because eligibility is based on your income for the calendar year, not your income once you become an attending, it's worth evaluating before year end. Next, a Roth conversion is different. Unlike Roth IRA contributions, there's no income limits on conversions. Instead, the question becomes whether you're comfortable paying the income tax associated with converting pre-tax retirement assets into a Roth account. For many doctors, this may be one of the lowest tax brackets you'll experience for decades. That creates an opportunity to voluntarily recognize taxable income today in exchange for potentially tax-free growth going forward. Accounts to consider may include traditional IRAs, former employer retirement plans that can be rolled into an IRA, or in some employer plans, they would allow in-plan Roth conversion opportunities, which may be available. Again, the goal isn't simply to convert everything. It's really to evaluate whether the temporary tax environment you're in creates an opportunity that aligns with your broader financial plan and vision. Third, capital gain planning. This is one of the least discussed planning opportunities we see. Most investors think of capital gains as something to avoid recognizing almost at all costs, but during a lower income transition year, it may actually make sense to intentionally recognize some long-term capital gains. If your income falls within the 0% federal long-term capital gains bracket, you may be able to recognize gains without paying federal capital gains tax. For 2026, that threshold is based upon taxable income and is adjusted annually by the IRS. So even more interesting, unlike losses, there's no wash sale rules for gains. That means in some situations, you can recognize a gain, immediately repurchase the same investment, effectively establishing a higher cost basis for future years. So if your income and potentially your capital gains tax rate is expected to be much higher in the future, that higher basis may reduce taxes later on. Like many things we've discussed throughout our transition year series on other videos, it's less about today's transaction and more about understanding how today's decisions can affect tomorrow and the future. Now, retirement contributions, as your income begins to increase, retirement contributions become another area worth coordinating. You may be getting a signing bonus. You may only work as an attending for part of the year. Your employer-sponsored retirement plan may offer both pre-tax and Roth contribution options. So rather than automatically selecting one, it can be helpful to evaluate how retirement contributions fit into your overall tax picture for the upcoming year. In some situations, reducing taxable income through pre-tax contributions can make a lot of sense. In others, paying the taxes today through Roth contributions could be appropriate because of your relatively lower income during this transition year. So the important point is that these decisions shouldn't be made independently of everything else happening around you this year. Now, one of the most common surprises for new attendings isn't how much tax they owe, it's how much tax wasn't withheld. As your income changes, your payroll withholding often needs to reflect that as well, and those changes need to take place. Signing bonuses, productivity bonuses, higher salaries, this can all create situations where your withholding doesn't accurately reflect your eventual income tax liability. So it's important to remember that withholding is simply a prepayment towards your eventual tax bill. It's not your actual tax calculation. If too little is withheld, you may owe a significant balance when you file your return. If too much, you've essentially provided the government with an interest-free loan on your money. Reviewing your withholding after starting your new position can help reduce some surprises come next April. Finally, let's talk about signing bonuses. These are often exciting, and for many doctors, they're one of the first examples of variable compensation, but it's important to understand exactly how they're structured. Questions to ask include, is the signing bonus taxable? When is it paid? Does it include a repayment provision if your employment and tenure with that employer ends early? Is some type of relocation assistance included? Now, under current federal tax law, relocation reimbursements for most civilian employees are generally treated as taxable compensation. So it's important to understand how those payments affect your withholding and overall tax picture. Some employers, they also may offer student loan repayment assistance as part of the recruitment package. Those bonuses are often taxable as well, although the exact tax treatment depends upon how the benefit is structured and whether specific tax provision would apply for you. Understanding these details before formally and finalizing an offer can help avoid some surprises after your first paycheck arrives. Now, your transition year is unique. Again, not because every one of these opportunities will apply to you, but because it's one of the few years where your taxable income may be temporarily lower than what you'll experience over the rest of your working career. So the goal isn't to pursue every opportunity. It's to understand which ones may be relevant and understanding how they fit into your overall coordinated plan. So if you'd like a structured way to think through this transition, we've actually created a transition planning checklist, we'll include in the link below for this video. And if you're interested in learning and finding out more and getting better educated on content like this, certainly subscribe to the channel. We'll continue releasing resources for doctors navigating the transition from training into practice.